1490 AD Florence. The Medici Bank operates with only 5% cash reserves. That means for every 100 florins deposited by customers, only 5 sit in the vault. The other 95 are loaned out to kings, popes and nobles. This is standard practice for Florentine banks. It works brilliantly, until it does not. Meanwhile, Lorenzo the Magnificent is spending the bank's money on art. Michelangelo Botticelli, Leonardo da Vinci, palaces, festivals, political bribes. He raids Florence's state treasuries to cover shortfalls. He even defrauds the Monte del Dote, a charitable fund for paying poor girls' dowries. The richest bank in Europe is going bankrupt, and its owner is too busy funding the Renaissance to notice. By 1494, every single branch of the Medici Bank has either failed or separated. The London branch collapses, owing 51,533 florins it cannot repay. The Bruges branch is insolvent from lending to Burgundian royalty who default. The Lyon branch is taken over by competitors. The Rome branch is technically independent but buried in debt. The family that invented modern banking destroys itself in 3 generations. But here is what makes this different. This was not a sudden crash. This was a slow-motion collapse over 30 years that everyone saw coming. The best bankers in Florence warned Lorenzo repeatedly. He ignored them. He could not stop spending, he would not change course. And when the money ran out, he stole from the city's charitable funds to maintain his lifestyle. How did the family that invented the Renaissance destroy the bank that funded it? And why are we watching the exact same pattern play out right now with modern banks drowning in bad commercial real estate loans? This is the story of the Medici collapse. By the end, you will understand the 7 steps that destroy every overextended bank. See how Lorenzo's choices doomed 3 generations of success. And recognize the warning signs flashing in regional banks today. This is not just history, this is a warning. It is 1397, Florence. Giovanni di Bici de' Medici opens a bank. He is not from the old nobility, he is a merchant's son. But he understands something the aristocrats do not. Money creates power more reliably than bloodlines. Walk through Florence and you see a city transforming. The smell of wool dye from textile workshops. The clang of metal. The bustle of merchants negotiating in the Mercato Vecchio. This is a commercial republic. Money talks, trade rules, and banking is the engine that makes it all work. In this world, the Catholic Church forbids usury. Charging interest on loans is a sin, but bankers find clever workarounds. They call it discretionary interest, or exchange fees, or service charges. The Pope looks the other way because he needs bankers too. In fact, he becomes the biggest customer. Giovanni's genius is spotting an opportunity. The papacy needs to move money across Europe. Taxes from England, tithes from Germany, donations from France, all flowing to Rome, but physically transporting gold is dangerous and slow. Giovanni offers a solution. His bank will handle transfers, accept deposits in London, pay out in Rome. No gold crosses borders, just letters and accounting. By 1420, the Medici Bank becomes the official banker to the papal court. This is the breakthrough. Papal business is steady, reliable, enormous. It makes the Medici wealthy, but more importantly, it makes them necessary. Popes come and go. The Medici Bank remains. Meet Cosimo de' Medici, Giovanni's son. He inherits the bank in 1429. He is a better banker than his father, methodical, cautious, brilliant at managing people and risk. Under Cosimo, the Medici Bank expands to 9 branches across Europe: Rome, Venice, Geneva, Bruges, London, Avignon, Milan, Naples, Pisa. Each branch operates semi-independently but reports to Florence. Cosimo's system is sophisticated for 1440. Each branch is a separate partnership. The Medici family invests capital. The branch manager invests smaller capital and takes a share of profits. This aligns incentives. If the branch succeeds, everyone wins. If it fails, the Medici limit their losses to the branch's capital. Other Florentine banks might collapse entirely from one bad branch. The Medici system contains the damage. But there are cracks in paradise that nobody sees yet. The branches have too much autonomy. Distance is vast. Communication is slow. A letter from London to Florence takes weeks. By the time Cosimo learns about a problem, the damage is done. Branch managers make decisions that benefit themselves more than the bank. And the biggest risk is the one driving all the profits. Lending to royalty. Kings and dukes borrow enormous sums. They need money for wars, for lavish courts, for political schemes. They offer good collateral, mining rights, tax revenues, exclusive trade privileges, and they pay high interest. This seems like great business, but there is a hidden problem. You cannot foreclose on a king. If he decides not to pay, what can you do? Sue him, seize his castle. Kings have armies, bankers have ledgers. Meet Tommaso Portinari, he manages the Bruges branch starting in 1465. He is charming, well-connected, ambitious. He ingratiates himself with the Burgundian court. He loans them money, lots of money, first to secure farming rights for the toll of Graveline, which never becomes very profitable. Then for social prestige, to elevate himself, to mingle with dukes and duchesses. But Angelo Tani sees the danger. He works for the Medici Bank. He watches Portinari making reckless loans. He appeals to the Medici headquarters to restrict London branch lending. Portinari is creating huge exposure to Burgundian royalty who might default. The answer comes back from Lorenzo de' Medici in Florence. He does not understand such matters. Trust Portinari. Nobody listens to Angelo Tani's warnings. What none of them know yet is that Portinari's loans will destroy the Bruges and London branches completely, and that Lorenzo's incompetence will accelerate the collapse of the entire bank. 1464. Cosimo de' Medici dies. His son Piero inherits the bank. Piero is 48 years old. He has gout. He is bedridden much of the time. He has no banking experience, but Piero is cautious. He reviews the books. He sees problems. Overextension, bad loans, insufficient reserves. He makes a controversial decision. Call in loans. Tighten credit. Consolidate. This triggers a crisis. In 1465, Piero demands repayment from multiple borrowers simultaneously. Some cannot pay. They default. Their defaults trigger panic among other depositors. Bank runs threaten. For a moment, the Medici Bank teeters, but Piero's ruthlessness saves it. He closes weak branches. Milan in 1466. Writes off bad debts, restructures. Within 2 years, the bank stabilizes. It is smaller but healthier. Then in 1469, Piero dies. His sons Lorenzo and Giuliano inherit. Lorenzo is 20 years old. He has been groomed for politics, not banking. He is a brilliant poet, a skilled diplomat, a patron of the arts. He has no business training whatsoever. He will later admit that his lack of knowledge was the reason he approved disastrous schemes. He simply did not understand banking. Lorenzo makes a fateful choice. He delegates bank management to Francesco Sassetti. Sassetti becomes the ministro, the general manager. Lorenzo focuses on what he loves: politics, poetry, art, philosophy. He assumes Sassetti will handle the money, and for a while, it works. 1471. Lorenzo opens a new branch in Naples. It is a political move, not an economic one. Service to the court and aristocracy is the chief reason. The Naples branch never makes consistent profits. It exists to create political relationships, to influence the Kingdom of Naples, to expand Medici power. The same logic applies to Milan. The branch there serves the Sforza dukes. Personal loans to the aristocracy create severe and ultimately insurmountable problems. But Lorenzo does not care about profitability, he cares about influence. The bank becomes a tool of political ambition, not economic growth. Then in 1478 comes the Pazzi conspiracy. The Pazzi family and Pope Sixtus IV plot to assassinate Lorenzo and Giuliano. They strike during Easter Mass in the Duomo. Giuliano is killed. Lorenzo barely escapes. The coup fails. Lorenzo executes the conspirators, hangs them from the windows of the Palazzo Vecchio, but this costs money. Lots of money. Military preparations, bribes, political maneuvering. Where does the money come from? The bank. Lorenzo raids the Medici Bank's reserves to fund his political survival. Francesco Sassetti protests weakly but complies. The bank's capital is diverted to political purposes. Return on investment becomes secondary to political necessity. By 1480, multiple branches are in crisis. The Bruges and London branches are connected. The London branch makes bad loans. Those debts are assumed by Bruges. Portinari is managing both. He lives in Florence and only visits the Low Countries for business. The branches are out of control. Portinari makes catastrophic decisions. He purchases 2 galleys for shipping. They are partially sold at a loss. The rest is lost to shipwreck and piracy. He invests in failing ventures. He refuses to return some deposits, claiming they were really partnership investments. He claims Angelo Tani as a full partner liable for losses, even though Tani opposed the risky lending. By 1481, the chaos is undeniable. Portinari's contracts are so favorable that the Medici family bears almost all losses while he takes a share of phantom profits. The London branch owes 51,533 florins it cannot repay. King Edward IV of England borrowed heavily. When he dies in 1483, the new regime refuses to honor his debts. The English monarchy defaults. The London branch collapses. The Bruges branch follows in 1481. Burgundian royalty borrowed for wars against France. They lost the wars. They lost their territory. They cannot repay. The branch is insolvent. It closes. The Medici lose everything invested in the Low Countries. In Lyon, the branch fails differently. Competitors take it over. The Medici cannot compete. They are undercapitalized, outmaneuvered. The Lyon branch separates and continues under new ownership. Not a Medici operation anymore. Lorenzo does not cut spending. Instead, he increases it. The Medici family's fiscal problems grow severe enough to force Lorenzo to raid Florence's state treasuries. This is embezzlement. Theft from the public funds. He defrauds the Monte del Dote, a charitable fund for paying dowries for poor girls. This is the moment. The richest banker in Italy is stealing from charity to maintain his lifestyle. He spends lavishly on Michelangelo, on Leonardo da Vinci, on building projects, on festivals, on maintaining political power, all funded with other people's money. The bank cannot support this. But Lorenzo cannot stop. In 1492, Lorenzo dies. He is 43 years old. In his diary, he wrote in capital letters, "One cannot live in wealth in Florence without the state." He understood that political power and economic power are inseparable, but he chose politics over economics. He destroyed the bank to build the Renaissance. His son Piero di Lorenzo inherits. Piero is 20 years old. He has neither business acumen nor political skill. He depends on his secretary and his great-uncle Giovanni Tornabuoni to handle everything. They mismanage, they make bad decisions. The bank is already tottering on bankruptcy when Piero takes over. Then in 1494 comes the crisis that ends everything. King Charles VIII of France invades Italy. His army marches south toward Florence. Piero panics. Without consulting the Florentine government, he surrenders to Charles. He concedes everything. Florence's fortresses, its independence, its dignity. The Florentines are outraged. They exile the Medici family, confiscate their property. A mob burns the central Florentine bank. The Roman branch strikes off on its own despite being bankrupt. The Lyon branch is already gone. By 1494, the Medici bank has closed all branches and is nearly bankrupt. The trigger is not financial, it is political, but the underlying insolvency has been building for 30 years. Lorenzo hollowed out the bank to fund his political and artistic ambitions. Piero's incompetence accelerated the collapse. The French invasion was just the final push. Meet the depositors who trusted the Medici name. Their savings are gone. The bank cannot repay. Some recover pennies on the pound. Most recover nothing. These are merchants, craftsmen, shopkeepers, people who believed the Medici bank was safe because it had been safe for 97 years. Meet the branch managers who followed instructions. They loaned to royalty because Lorenzo wanted political influence. Now those loans are worthless. The managers are liable for the losses. Some are ruined. Others flee. The carefully structured partnership system collapses. But the Medici family survives. They are exiled in 1494. They return in 1512. They become popes. Leo X in 1513. Clement VII in 1523. They become dukes of Florence. Cosimo I in 1537. The family transitions from banking to dynasty. They no longer need the bank. Political power sustains them. The bank was a tool they discarded when it stopped being useful. And the winners, the Medici's competitors, other Florentine banks, Pazzi Strozzi, they pick up the pieces. They serve the clients the Medici abandoned. They learn from the Medici's mistakes. Do not overextend to royalty. Do not subordinate banking to politics. Do not raid the treasury to fund art. By 1500, the Medici Bank is a memory. It contributed little to economic growth in its final decades. Too many funds were used to finance conspicuous consumption of royal courts or the exploits of condottieri, captains of mercenary armies. The bank that invented modern finance became a slush fund for Renaissance excess. So what really happened? History books say the Medici Bank failed because of poor management and bad luck, but that is not just incomplete, it is dangerously wrong. Here is what actually happened. The Medici Bank failed because it operated on 5% reserves while making increasingly risky loans to uncollectible borrowers. When those loans went bad, the bank had no cushion. It collapsed immediately. Let me break this down. The banking system in 15th century Florence was built on fractional reserves. Banks accepted deposits and loaned most of them out. This creates profits, but also fragility. If 10% of loans go bad, a bank operating on 5% reserves is insolvent. The math is simple and brutal. Cosimo understood this. He managed risk carefully. He diversified lending. He maintained relationships with creditworthy borrowers. He kept reserves adequate for normal operations. The system worked because Cosimo made it work. Lorenzo did not understand this, or he understood but did not care. He approved loans for political reasons, not economic ones. Tommaso Portinari wanted to loan money to Burgundian dukes to elevate his social status. Lorenzo approved it because he wanted Medici influence at the Burgundian court. When the dukes defaulted, Lorenzo's decision cost the bank everything. Think of it like this. Imagine you run a bank with $100 in deposits and $5 in reserves. You loan $95 to wealthy people who might not pay you back. If $10 worth of loans default, you are insolvent. You owe depositors $100. You have $90 in performing loans and $5 in reserves. That equals $95. You cannot pay. That is exactly what happened to the Medici Bank. Multiple branches loaned heavily to royalty. English monarchy, Burgundian dukes, Italian condottieri. These borrowers defaulted or delayed payment indefinitely. The branches became insolvent, and because the whole system operated on thin reserves, the insolvencies cascaded. But here is what nobody talks about. Lorenzo knew this was happening. Francesco Sassetti warned him. Angelo Tani warned him. Multiple managers pointed out the danger. Lorenzo ignored them all. He once said he did not understand such matters when asked to restrict reckless lending. He later admitted his lack of knowledge was why he approved disastrous schemes. This was not ignorance. This was willful negligence. Lorenzo prioritized his interests over the bank's survival. He wanted political power. He wanted artistic legacy. He wanted to be Lorenzo the Magnificent. The bank was a means to that end. When the bank became an obstacle, he looted it. The system was designed to transfer wealth from depositors and prudent managers to Lorenzo's political and artistic ambitions. Branch managers who made sound loans earned modest profits. Lorenzo, who made terrible loans for political reasons, took the bank's capital. This was not accident. This was extraction. Now let me show you the pattern. This is the banking failure formula. It happens every time. First, success through prudence. The bank succeeds by careful lending, diversified portfolio, adequate reserves, strong leadership, customers trust it, deposits grow, the bank appears invincible. Second, generational transition. The founder dies. The heir inherits. The heir lacks the founder's skills or discipline. But the bank's reputation survives. Everyone assumes the new management is as competent as the old. Third, mission drift. The bank starts serving purposes other than banking. Political ambitions, social prestige, personal enrichment. The original discipline erodes. Lending standards weaken. Fourth, concentrated risk. The bank makes large loans to few borrowers, royalty, connected insiders, politically powerful people. These loans are risky, but the bank cannot refuse them without losing influence. Fifth, inadequate reserves. The bank operates on thin capital. Profits are distributed instead of retained. When loans go bad, there is no buffer. Insolvency is immediate. Sixth, the cascade. One branch fails. Then another. Depositors panic. They demand withdrawals. The bank cannot pay. The system collapses. Seventh, the wealth transfers from depositors to whoever controlled the extraction. In the Medici case, Lorenzo extracted wealth for political and artistic purposes. Depositors and branch managers were left holding the losses. This pattern repeated in every bank failure before modern regulation. Bardi and Peretti banks in the 1340s, Medici in 1494, numerous Florentine banks throughout the Renaissance. The mechanism is identical. Now let us talk about 2024 and 2025. Right now, US regional and community banks are facing the exact same pattern as the Medici. They hold massive commercial real estate loans. Those loans are going bad, and the banks do not have enough capital to absorb the losses. The numbers are devastating. As of June 2024, outstanding commercial real estate loans in America amount to nearly $3 trillion. About $2 trillion worth of commercial real estate mortgages are scheduled to mature from 2024 through 2026. Roughly $570 billion more come due in 2025 alone. Many cannot be refinanced at current interest rates. The delinquency rate for office loans surged to 10.4%, just shy of the 2008 financial crisis peak. Office vacancy rates hit a record 13.2% in 2023. Malls reached 8.8% vacancy. Properties bought with cheap money in 2020 and 2021 are now worth 30 to 50% less. Banks are underwater on these loans. Sound familiar? Let us run through the checklist. Success through prudence. Czech regional banks succeeded for decades by lending to local businesses and real estate. It was steady, reliable, safe, until it was not. Generational transition. Not exactly a generation, but the same principle. Pre-2020 bank leadership understood traditional lending. Post-2020 leadership assumed cheap money would last forever. They loosened standards. Mission drift. Check. Small banks with assets between $0 and $10 billion have approximately 48.2% of their total loans tied to commercial properties. For banks under $10 billion in assets, the CRE to capital ratio averages 366% in 2024. That is extreme concentration. They are not diversified banks anymore. They are commercial real estate lenders. Concentrated risk. Czech 67 banks have commercial real estate exposure greater than 300% of their total equity as of Q1 2024. The industry average is 139%. These banks are massively concentrated in one asset class. Inadequate reserves. Check. When properties lose 30 to 50% of value, banks must write down loans. But they have insufficient capital to absorb the losses. New York Community Bancorp had a CRE to capital ratio of 617% in 2024, one bad quarter, and they needed a $1 billion emergency investment to survive. The cascade it is starting. In March 2024, Jerome Powell testified to the Senate Banking Committee. He said there will be bank failures from commercial real estate exposure. His exact words, "There will be bank failures." Treasury Secretary Janet Yellen agreed. Some failures are coming, but the situation will be manageable. By November 2024, commercial real estate redefaults hit $5.5 billion, up 90% year over year. That is the highest level in 10 years. These are loans that were modified once, then defaulted again. Banks extended and pretended, gave borrowers breaks, lowered rates, extended maturities. Now those modified loans are defaulting anyway. The transfer, we will see. In 2008, depositors were protected by FDIC insurance. Shareholders and bondholders lost everything. This time will probably be similar. Small bank shareholders will be wiped out. Depositors will be made whole by FDIC. Taxpayers will fund the bailout. Now, is this exactly like the Medici? No. We have FDIC insurance. We have better accounting. We have regulatory oversight. These differences matter. They prevent total systemic collapse. But the fundamentals are identical. Banks made concentrated bets on one asset class, commercial real estate. They operated on thin capital. They assumed values would not fall. They were wrong. Now they face insolvency. What is different? The scale. The Medici Bank had 9 branches across Europe. Today's regional banking system has hundreds of banks with trillions in assets. The concentration is worse. Small banks have 48% of loans in CRE. The Medici never put half their capital in one sector. The speed Medici decline took 30 years. Modern banking crises unfold in months. Silicon Valley Bank failed in 48 hours in March 2023. First Republic followed in 6 weeks. The extend and pretend strategy delays, but does not prevent the cascade. What should you watch for? First, delinquency rates. The non-current rate for non-owner-occupied CRE loans was 1.59% in Q4 2024. That is the highest since 2013. If this crosses 2%, failures accelerate. Second, bank capital adequacy. If a bank's CRE exposure exceeds 300% of equity, it is vulnerable. If that exposure is concentrated in office or retail, it is extremely vulnerable. Check your bank's quarterly filings. Third, extend and pretend. If banks keep modifying loans instead of foreclosing, they are hiding problems. Eventually those modified loans default anyway. The 90% increase in redefaults proves this. Fourth, deposit flight. If large depositors start withdrawing from regional banks, the cascade begins. Bank runs are digital now. They happen in hours, not days. I am not predicting another 2008. I am not saying the whole system collapses. I am showing you the pattern. The pattern Lorenzo created 530 years ago. Concentrated risk. Thin capital. Bad loans, inadequate reserves, inevitable insolvency. So why do we keep falling for this? Because banking failures are not accidents. They are features of fractional reserve banking combined with poor risk management. We are wired to trust institutions. We assume banks know what they are doing. We believe regulators prevent disasters. Bankers are wired to take risks during boom times. Commercial real estate was booming in 2020 and 2021. Property values soared. Rental income looks solid. Lending seemed safe. Why not concentrate exposure? Everyone else was doing it. Regulators are wired to fight the last war. After 2008, they focused on mortgage-backed securities and investment banks. They did not focus on commercial real estate at regional banks. The concentration built up under their watch. Lorenzo the Magnificent thought he could spend the bank's money on art and politics without consequence. Modern bankers thought they could concentrate in CRE without consequence. Both were wrong. The laws of banking do not change. Thin reserves plus bad loans equals insolvency, always. But here is what this story really teaches us. The disaster is not the failure. The disaster is the decade of warnings everyone ignores. Angelo Toni warned Lorenzo in 1478. Lorenzo said he did not understand such matters. Fed Chair Powell warned about CRE exposure in March 2024. Banks kept lending. The Medici depositors who lost everything were not reckless gamblers. They were ordinary Florentines who trusted the most prestigious bank in Europe. Modern depositors at regional banks are not reckless either. They assumed FDIC insurance and regulators kept them safe. Every generation thinks their banking system is different, better regulated, more sophisticated, more resilient. Every generation discovers the same fundamental truth. Banks that operate on thin reserves while making concentrated bets will fail when those bets go bad. The question is not whether more regional banks will fail. Fed Chair Powell said they will. The question is how many and how fast, and whether the FDIC can handle the cascade without requiring taxpayer bailouts. Understanding this does not give you a crystal ball. The Medici Bank operated on thin reserves for 60 years before failing. Modern regional banks might survive for years with extend and pretend. Timing is impossible to predict, but pattern recognition is priceless. When you see banks with 300% CRE exposure ratios, you know they are vulnerable. When you see delinquencies at 10-year highs, you know stress is building. When you see extend and pretend instead of foreclosures, you know banks are hiding problems. You cannot control bank management. You cannot control commercial real estate values. You cannot control regulatory oversight, but you can control where you keep your money. You can check your bank's CRE exposure. You can ensure deposits stay under FDIC limits. You can recognize the pattern before the cascade begins. The Florentines who survived the Medici collapse were not the ones who trusted the biggest bank. They were the ones who diversified, who kept some wealth in other institutions, who recognized warning signs, who understood that past success does not guarantee future survival. That lesson is 530 years old. It is timeless. Now, I want to hear from you. Do you see the Medici pattern in regional banks today? Is your bank overexposed to commercial real estate? What am I missing? Drop your thoughts in the comments. The best analysis often comes from you, not me. If this changed how you see banking risk, hit that like button. Subscribe if you want more economic history that actually matters. Next time, we are diving into the Bardi and Peruzzi bank failures of the 1340s. When lending to English kings destroyed the two largest banks in Europe and triggered a continent-wide financial crisis. Another pattern hiding in plain sight. Another lesson they do not teach in school. Remember, history does not repeat, but it rhymes. And right now, Jerome Powell is rhyming with Angelo Tani. See you in the next one.